Let's talk about adjustable rate mortgages. Let's talk about the adjustable rate mortgage basics. Just so you know, these are also known as ARMs. So ARM is an acronym for adjustable rate mortgage. So what is it? Well, it's what it sounds like. Your interest rate can and probably will adjust at some point during the mortgage. So fixed rates and ARMs. Those are your only really two options. Your rate either is going to be fixed and it never changes, or it's not a fixed rate, therefore it's an adjustable rate mortgage. In the old days, adjustable rate mortgages change like every freaking month from the day you closed. In today's world, most of the mortgages are going to have some sort of fixed rate period that goes with it. And then after that fixed rate period is when they will adjust. So you can have the most common are going to be the 5, 7, and 10-year ARMs. So it's the rates are fixed for at least that 5-year period or that first 7 years or the first 10 years. And then after that is when they'll start adjusting. Just to be very clear, there are other ARM durations. You can get like a 1, 3, 5, 7, 10. I've even seen a 15-year ARM. So those are the most common, but like I said, those three, the 5, 7, and 10 is kind of where you're talking about, kind of the most common. So let's talk about the basics. Let's talk about what you need to know and all the numbers that show up when somebody talks about an ARM. We'll then talk about why it makes sense, when you do it, why you wouldn't do it. But let's just talk about what it is real quick. So the adjustable rate mortgage basics here, right? So these are 30-year, most of them. Again, I'm not going to speak for every program out there, but I'll say in general, the 30-year loans. So you can get an ARM, you can have it for the whole 30-year duration, but you just don't know what your rate's going to be for the entire 30 years. But they are 30-year loans. And then they have a couple of like terms that go with it. So let's talk about those. They have what's called like fully indexed rate. They have floors, they have caps. So let's talk about what all that means. So first of all, as we talked about, there's a fixed rate period. So we're going to take, let's say, a 5-year ARM in this example. Actually, we're going to take a 7-year ARM in this example. So we're going to say there's a 7-year ARM that somebody wants, that they want to get. That means for the first 7 years of the loan, the rate is going to be fixed. After that's going to adjust. So why would somebody want an ARM? Well, first of all, ARMs are going to be typically, there have been times like during COVID and economic times where this isn't always the case, but in general, for the most part, ARMs are going to have lower interest rates than fixed rate mortgages. So if you want to borrow money for 30 years, fixed rate, you're going to have a rate of X. And the reason why it's going to be higher is because lenders just don't know exactly where rates are going to be. And there's always a cost to lending money. So if you do an ARM, 10-year, 7-year, 5-year, whatever it is, the shorter that fixed rate period, the lower the interest rate. And the reason being is you're reducing the risk that maybe a banking or lending institution has to take on, because if you said, I only want to borrow if I loaned you 20 bucks and you're going to pay me back in an hour, there's a lot less risk than if you say, hey, I'll borrow 20 bucks and pay you back in a year. You might forget about it, right? I understand you're not going to forget about a mortgage, but you get the point. So the shorter you go, the lower the initial interest rate should be. So on a 7-year ARM, you're going to have what they call caps. Well, in all these ARMs, you're going to call caps. There's 3 different numbers that go with it. So we're going to use a common one, which is 525. So you might see 7-1 ARM with a 525 cap. What does that mean? Well, the first one, in this example, the 5, is going to tell you how much your rate can adjust on the very first adjustment. So if you get a 7-1 ARM, and I skipped a step and I didn't mean to, sorry, on a 7-1 ARM, like most of these ARMs are all going to be ones. You're going to see 7-1, 5-1, 10-1. That 1 just means it'll adjust every year. That's the 1. So 7-1 ARM, it's going to be, okay, here's a 7-1 ARM. And that means every year after year 7, on year 8, 9, 10, and beyond, every year is when the interest rate is going to be reevaluated and adjusted. So on a 7-1 ARM, the caps are 525. So if somebody comes out and says, I got a rate of X for my 7-year fixed rate period, after 7 years are over, that first number, that 5, says that the rate can go up or down 5%. So X plus 5 is the max that can go up on that first adjustment. You can also have X minus 5 as a possibility. The reality is there are also floors. So let's talk about that real quick. They'll have a floor rate that says your rate can't go below X. So if you get a rate, you can't have a negative interest rate. They probably won't even give you one that's super, super low. They're going to put a floor on there that says, hey, they're at least going to have to pay this much even if that's -5, that's the floor is going to come in and trump that piece. But in general, you typically get arms where you're going to see 525. That first 5 is how much it can go up, the max it can go up in that first adjustment. So after 7 years, it can go up at least X plus 5%, X being your rate. The second number, the 2 in this example, that 2 is the max it can go up or down every subsequent adjustment. So in this example, a 7-1 arm says that the first year in year 8, after 7 years, the start of year 8, it can go up a max of 5%. But maybe it does, maybe it doesn't. Whatever it goes up to, we'll talk about how and what that number is in a minute. But then the number 2 says on year 9 in this example, and year 10, 11, it can only go up or down that 2% thereafter. That's that middle number. And then finally, the last number, 5, coincidentally the same as the first in this example, but that's pretty common, says that that's the lifetime, how much it can go up or down compared to your initial start rate. So the most it could ever go up is X plus 5. The most it can go down is X minus 5 with consideration of that floor I just talked about. So understand that last number oftentimes matches the first, but that last number is the lifetime, how much you can go up or down. The first one's just on that first adjustment, how much you can go up or go down. So that's on a 7-1 arm, 5-1 arm, 10-1 arm. You'll often see 5-2-5 for those caps. That's what they mean. Again, the first one is how much you can adjust in the first adjustment period. The second number is how much you can adjust each subsequent period after that. And the third one is the max life of the loan. So hopefully that gives you an understanding of what those caps are. I did mention, and it's worth saying real quick, but you might hear like a 7-6 arm. If that 7-1 arm, if you see a 6, all that means is it adjusts every 6 months. Those aren't as common. They do exist. You just don't see them very much. But the 1 is the most common. So 5-1, 7-1, 10-1. But just understand that 1 is a 6. It typically means 6 months. So hopefully that at least throws that in there. So now let's talk about like the rate. What is the rate? They call it a fully indexed rate, is how you ultimately start paying. So whatever rate you get for that first 7 years in our example, that's your fully indexed rate. So how do they come up with that number? Well, first of all, the fully indexed rate is not necessarily what you're going to be paying for that first year. The fully indexed rate is what you're going to be paying for all those when it does adjust. So let's explain the difference. When you come out and there's a rate of X, when you get this 7-year arm, that X is obviously going to have some of these calculations already in it, but the lender's going to choose the X. Like, here's what your rate is for the first 7 years. And I'd say they choose it. It's not like they're just wildly picking things out of the air. The market chooses it, but the lender's going to give that to you. So now let's take 7 years later in this example, and your rate's going to start adjusting. Adjust to what? Well, it adjusts to essentially what they call the fully indexed rate, and that's the margin plus some type of index. So those are two different numbers that are going to come up and say, here's what your new rate's going to be. So in my example on a 7-1 arm, it's going to adjust after 7 years. And they're going to say, here's your new rate. And they're doing it this way. It's just a simple, easy formula. You can check them at home to make sure they're doing it right. They're going to take the margin, which is predetermined. That's what they do before closing. And they're going to say, hey, our margin is 2.5 or 3%, whatever it is. And usually, like I said, 2.75 is pretty typical, but 2.5 to 3%, that's the bank's profit. That's where they're making the margin, right? That's where it goes to the bank. So it's going to say, hey, when it adjusts, it's going to be a margin of X. So in this case, let's just take 2.5, let's take 3% for grains. Your margin of 3%, it's going to be a margin of 3% plus some index. So the index, way back in the day, it used to be LIBOR. That's no longer a thing. Could be a 1-year U.S. Treasury. They'll tell you the index whenever you go to close, before you even go. When you lock the loan, they'll know the index. So let's say it's a 1-year Treasury, right? You get to go in there and say, okay, here's what it is. Well, if the Treasury rates are at 4%, or whenever they do this, whenever it adjusts 7 years from now, you're going to take the 3% margin plus the 4% index, and that's what equals 7%. So your new rate could be 7% 7 years from now. But the problem is that index will change typically every month. It could be every day, right? But they're going to say, hey, here's where it's changing. So it's going to be the moment in time when it's time for your loan to adjust. They're going to say, let's go look at it. And here's what it is. And boom, that's now your new fixed or fully indexed rate for the next however long. So on a 7-1 arm, that'll be your rate for the next 12 months until it adjusts again on that subsequent piece. So that, in a nutshell, is an arm. And you may say, man, that's really complicated. It can be. It is. Now, why do people get ARMs? And this is what simplifies it. A lot of folks will get an ARM with they fully anticipate not having that mortgage before it adjusts down the road. So a lot of times, for example, somebody might get a 7-year ARM. I've done a 7-year ARM for a football coach. He was a D1 football coach. He hadn't lived anywhere for longer than 3 years because he's been following around. I think he was the offensive coordinator, and he basically followed around the head coach. So the head coach was initially a high school coach where they both started doing their careers. High school, they went to like a JUCO type or a small D3, college. They then worked their way up to D2, D1, and now they're in the NCAA. And now it's a big, football program. He was the offensive coordinator. So he's never actually been somewhere longer than three-ish years because they keep moving to get advancements in their careers. So for him, an ARM made total sense because he gets a lower rate, but doesn't expect to have it for a long, long time. The only reason why we did 7 is because this was a jump up to now a more established, very recognizable school, very recognizable football program where they thought they'd be there, but probably not longer than 7 years. And even if they were, here's the nice part about ARMs. Again, they're 30-year mortgages. You don't have to refinance out of it. It's just saying, let's pay attention that last year and a half before rates start to adjust to get a plan to say, do we want to let it? Because guess what? My mom had an ARM way back in the day, and the mortgage meltdown happened. And rates just kept going down, down, down. And then they were low for 10 years. Like that was the most killer program. If somebody gets it in the right cycle, they can be awesome. So it's not something to be afraid of. It's just understanding what it is and how it works. And that's working with a good mortgage professional and a great mortgage team that can, one, explain it, and then 2, make sure you know what you do, but 3, help you monitor that. It's not just close and be done and never look back. Let's close and let's pay attention to it. And let's make sure that we incorporate it in your overall financial plan. So that's a lot. I get it. If you have questions, rewatch the video. If you have questions beyond that, call us. We'll be happy to answer any and all your questions as it pertains to you and your loan. And just remember, forward, share, subscribe, all this stuff. If you know somebody that has interest in an ARM. And lastly, as always, when you think mortgage, think Mark.